an interesting theory that when rates go down, bond prices go up. And so there's an inverse relationship there. And so if you have bonds, it's a great time to hold on to them for a while because they're worth more. But if you're trying to buy bonds to get the yield, it's a little too late.
Well, after COVID, we saw some pretty high inflation. And as a response, the Fed raised interest rates numerous times, and those rates have stayed fairly high. This, on one hand, has been a good thing for savers, for investors, for those looking for income. On the other hand, if we're borrowing money, it has not been the best time for that. Now we expect those rates to begin to come down. And to talk about that, we'll check in with John Kuykendall, founder of GulfCoast Financial Services. Welcome into Financial Focus, brought to you by GulfCoast Financial, named Best of the Best in financial services 11 straight years and running by the readers of the Lake City Reporter. We've got founder and CEO John Kuykendall here with us. John, the interest rate environment has been in flux over the last several years, maybe more than any time, at least in recent memory. We've been in higher interest rates. Now they're expecting that we see an interest rate reduction. What does that mean for savers and investors?
Well, Peter, it's great for investors because if we have lower rates, then they can buy property. They can speculate more than they can if rates are higher. But for investors, it's another problem because a lot of our seniors are on fixed income, and they love those CDs and the fixed annuities, and those rates will be going down. So, on one hand, we get a little bit, on the other hand, we take it away. One sect versus another. And, I'm not sure how it's going to work out. For a number of years, probably 30 years in a row, we had predictable interest rates. And then in the 90s, we ended up with very unpredictable interest rates going way high and then coming back down. The Fed caused this inflation because they dropped rates so drastically during COVID to keep the economy going that inflation just ramped up.
Yeah, they were historically low right after
Yeah,
COVID. And then we saw, if it was not double digit, it was very close to double digit inflation rates for the
yeah.
a year or two post COVID. And I think that the response to that, John, was, well, let's raise interest rates to keep inflation under control. That was a relatively rough year when interest rates rose for equities and for fixed income, for stocks and bonds. Do we expect to see kind of the opposite effect as interest rates fall? Is that their hope, that they stimulate the economy and boost fixed income?
Well, it could stimulate the economy on one side. Like I said, seniors are going to be penalized, but the home market, the home builders, the real estate agents will actually benefit because we're having a problem right now because of the price of homes, having people qualify with these interest rates that we have today. They're having to put more down or go to a government loan. It's getting very difficult to get financing. And so that's why Florida has historically high bank, foreclosure rates, and also we have very high unsold home inventory is high. So I think that would benefit from that standpoint. But like I said, savers, on the other hand, are going to be penalized.
Right.
It's an interesting theory that when rates go down, bond prices go up. And so there's an inverse relationship there. And so if you have bonds, it's a great time to hold on to them for a while because they're worth more. But if you're trying to buy bonds to get the yield, it's a little too late.
They're already pricing in these expected lower interest rates, and will continue to do so as new bonds are issued, I would suspect. And I think that Florida might have a higher concentration, but I don't think it is exclusive just to Florida, the housing market has been very slow across the U.S. this year. Like you said, existing home inventory, a number of homes on the market, and the interest rates that people are having to finance for being so high, I think is one of the reasons. So housing certainly could be a stimulant for the economy if that begins to pick up thanks to declining and lowering interest rates on one hand, John.
Right.
Also smaller companies probably finance a lot of their
Mhm.
R&D and their overheads and costs. So maybe small businesses get a little boost from lower interest rates as well. But we do need to also worry because retirees are particularly subject to and exposed to changes in interest rates with things like bonds, CDs, annuities, savings rates, those kind of things.
Yeah, those rates will be going down. We'll be paying less. It will take more dollars to get the same income. So, it's going to be harder on those seniors, which it has been for a long time because interest rates have been historically low. So, it was when you're paying 2 and 3% on CDs, it's hard for people to make a living off of that and to live on it and pay their bills with inflation being about the same rate. But I think, Peter, it'll also benefit the car manufacturers because we'll be able to get car loans at a cheaper rate. Interest rate bond, the prime rate will go down and it will affect lending overall. Banks will be benefit. So there are segments of the economy that do benefit with lower rates. It's just that, post COVID created this influx of people moving from up north down south for some reason. I mean, they just finally found out we were here. They came in with cash and they bought these homes at asking price plus and drove the market up. Now we're having to live with that because that's kind of slowed down, almost stopped. And so we're having to, it's a normal real estate cycle now. And without lower rates, you're going to continue to see high inventories, builders in trouble, banks in trouble, because they're going to have more loans that they're going to be taking back.
John, retirees in general are a little bit more conservatively invested,
Yes.
not wildly speculative, not taking the full risk of the equity market, typically having some fixed income and bond component mixed in. Have we seen that those kind of investors, the fixed income, the bond, the more conservative investors, have been benefiting from this higher interest rate environment? Do we expect that they will continue to benefit, or are things going to get a little tougher on retirees and more conservative investors as rates decline?
Well, they're going to have to diversify more, Peter. We're going to have to look for more other instruments, like real estate investments, dividend paying stocks. There are some dividend paying stocks that have decent dividends, doing structured products or hybrid annuities so that we can get more yield. They're going to have to find ways because the bond market, bonds will go down, T bills will go down. High yield might go up, and that may be a way, take a little more risk and get a high yield bond that pays a little more interest.
Do you think that we're going to see a lot of people looking for those new alternatives as interest rates decline?
Yeah, I think you're right, Peter. I think that as rates decline, people are going to need, inflation's still here.
Right.
I mean, a Happy Meal ain't what it used to be at McDonald's. And so we're going to have to, as my wife told me the other day, as we're going to have to make more money in order to support our lifestyles. And as a retiree, how do you make money? You make money on your investments. So you have to have a yield coming in. And that's why we always, stress that income plan, the financially focused guaranteed income plan, where we can look at how much money you've got guaranteed coming in each month and how much your expenses are and how we're going to fill those gaps.
And John, income doesn't have to, and in many cases, nor should it, all come from one source. We
No.
should be diversified in our investment portfolio, as we've always heard, but also in our income generation.
Yeah, that's right, Peter. I looked at a client this morning who had brought me a statement from one of her 401ks, and it was close to $500,000. She's in 3 mutual funds. I told her, I said, that's really not great diversification, but she loved the funds. But you've got to be diversified. And as a retiree, we have to diversify our income. We have to have some, annuities, dividend paying stocks. We have to have that growth bucket working for us.
Well, falling rates could mean higher bond values, but also lower income. CDs, annuities, fixed income all may be paying less into the near future. Retirees in particular do feel this a little bit more. So, John, as you've stated, the solution is a diversified portfolio and planning. Build a plan that adapts with any interest rate environment. And that is what you help your clients with, a flexible plan that adapts when rates change.
That's right, Peter. We're diversified so that we can take advantage of any market. And if you don't have that financially focused income plan, then it's going to be difficult to see where we are and how we're going to get where we need to be. And so, with rates going down, people who are on fixed income will have less income coming in. They're going to have to make it up somewhere. And we don't want them to get so stressed out that they make a mistake and invest in the wrong thing because they're looking for yield.
Well, as always, John and the team there from GulfCoast Financial Services make one big offer here on the program. If you'd like to get your plan put together, your financially focused written retirement income plan, pick up the phone and give them a call. 386-755-9018, 386-755-9018. How to generate income, how to control and reduce taxes where possible, how to keep more of your money. Specifically, if you'd like to learn how to retire or make the best use of each and every dollar in your portfolio, you need to have a written plan. And that is what the financially focused written retirement income plan is all about. Available there at GulfCoast Financial Services. Give them a call, 386-755-9018, 386-755-9018. You can also go online and find them at GulfCoastFinancial.net, GulfCoastFinancial.net. John, having a plan improves your outlook for your financial future, no matter where we're at in life.
Well, you got to have a roadmap, Peter, and that's what this does. Gives you a roadmap to get from one point to another point, the most expedient way to get there, and also the safest.
Always a pleasure speaking with John Kuykendall, founder of GulfCoast Financial Services, best of the best in financial services, 11 straight years and running, as named by the readers of the Lake City Reporter. Give him a call, find out why, get your financially focused written retirement income plan, 386-755-9018, 386-755-9018, or online at GulfCoastFinancial.net.
Thank you, Peter. It was great to be here. See you next week.
Be sure to like, subscribe, share, and tune in for more financial focus by visiting GulfCoastFinancial.net. The information presented on this program is provided for informational purposes only, without warranty of accuracy, completeness, or suitability for a particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature and not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs. Early withdrawals may subject the owner to penalties, fees, or taxes. John Kuykendall is registered with and securities are offered through Kovac Securities Inc., member FINRA SIPC, found online at www.kovacsecurities.com. Advisory services are offered through GulfCoast Financial Services Inc., a registered investment advisor in Florida. GulfCoast Financial Services Inc. is not affiliated with Kovac Securities Inc. or Kovac Advisors Inc. Past performance is not indicative of future results. All investing involves risk. Investment decisions should be based on your own goals, time horizon, and tolerance for risk. Due to various factors including changing market conditions and/or applicable laws, the content may no longer be reflective of current opinions or positions. GulfCoast Financial Services, Inc. has been named as Best of the Best since 2015 in the category of Best Financial Advisor in the Lake City, Florida area. The award was based on receiving the most votes in this category from a survey offered and tabulated by the Lake City Reporter. No direct or indirect compensation was provided to the Lake City Reporter and/or any raters, and the award is not contingent on future direct or indirect compensation offered to the newspaper and/or raters. Portfolio performance is not a criterion, and voting is open to any readers of the newspaper.